I've heard so many of my clients go, well, I should just start my own insurance company. They're being coy about it, but then I'm
Right.
like, well, insurance, you're grouped together with everybody in the standard world. That's the worst of the best. You're grouped into the same pool. Whereas in the captive model, this is really best of the best. So you're not playing the same game at all.
It's kind of like self-insurance, but with airbags.
I'm telling these clients, I'm like, hey, consider captive because you control more of what happens. Right now, stuff is happening to you.
You really just are much more insulated from those market conditions in a group captive program.
It's so cool. I think this is one of the best concepts out there to really play the game at a level that just other companies can't. Well, everyone, welcome again to the Risky Assets Podcast. I have a very special guest with me, another insurance-y one, but I promise it's going to be a good one. This is Ian Mayster. Ian, thank you so much for being with us. This is going to be a really cool topic for a lot of people. You flew today from Arizona, right?
Yeah, Phoenix area. Yeah.
Is that home?
That is home now. Yeah, born and raised in the Chicago area, but I've lived out there for about going on 3 years now.
Right on, man. Well, that's great. And you're popping back, which is awesome that you just flew out here just for the podcast. So, dude, wanted to talk about just your history. Like, first of all, you work for Captive Resources. You guys do what I would call like self-insurance groups. And for entrepreneurs out there, it's just a really fascinating way to go about your insurance program, completely different than the normal way of just doing insurance. So, first of all, tell us your insurance background, like how you got to Captive Resources, and like just give us the rundown.
Yeah, of course. Thanks again for having me. Appreciate it.
Yeah.
And beautiful studio we got here. But yeah, so I got my start in insurance actually in college. I started studying finance in school, and then found out that my school had a pretty good insurance program.
That's really rare. By
Very
the way.
rare, yeah. And I had not much interest at all
Not
going
many
into
people
it,
do.
right. And it, a lot of people say it just kind of finds you, and that's how it worked out well for me. But yeah, I had some other colleagues at school that told me about it, and was able to complete two of those degrees within 4 years. And
what school is this that's offering insurance classes, by the way?
There's a few out there, but I went to Illinois State University.
Okay, cool.
So yeah, they had a pretty good program for several years there, and they still do, of course. But it was great because it really kind of opened you up to some of those different areas within the commercial side of insurance, as well as networking you with some of the businesses in the industry that are looking to attract some talent from that level. And sure enough, that's how I came across Captive Resources when they were back in 2017, really starting to grow the company and take on some interns as well. And it was kind of the right place at the right time thing for me.
That's amazing. So Captive Resources is the gorilla. They're the big boys. So they were growing in that time?
Yeah. So the company started in the mid-1980s, and we've consistently grown since then. But I would say definitely in the last 10 years we've seen a lot more uptick in demand and interest throughout the country.
Of course.
And so that's really when it started to really becoming a bigger company, and attracting more insureds throughout the country to look at an alternative product out there like a group captive model.
Right. So you started Captive in 2000.
17 and then 18 full-time.
Full-time, okay. And then, so you came straight from college to that. So there was no like middle in between, straight to the big leagues.
It was, and I pushed back. I was like, I think I'd be great here, this and that.
Sure.
I want to work
Having
here.
no idea what to do.
No, but it was good because still a growing company, and I noticed some areas within, at least marketing where, you could fill in with somebody like myself, young, and just help out, kind of grow with some, materials and documents, all that kind of good stuff, and just help our salespeople, out in the field. And so it worked out really well, and the position has kind of continued as well as after I've graduated on from there, and the company continues to grow. I don't work there at the headquarters anymore, but I think we're adding somewhere in 60-70 employees this year.
Amazing.
So it's
adding
fascinating.
a company a year basically, and people,
I know it's
really great.
It's really exciting to watch.
That's cool. So for the people out there, right, insurance is very basic in the sense you pay your premium, you get insurance back. Like if you have a claim, they pay the claim.
Right.
That's it. Like it's really basic and from a holistic perspective. Captive Resources and what you guys do, completely different yet semi the same.
Yeah.
So tell us about the Captive Resources and what the captive is for people who own businesses, right?
Yeah, sure. So we're a captive consultant. We're not an insurance broker or anything like that. But really what we do is we work with member-owned group captives And so they're going to be essentially an insurance company that is controlled and owned by these businesses that participate in it.
Right. So that means I buy into this insurance company and I'm a part owner.
Correct.
Right.
Correct. So rather than, again, going out and just having that contractual risk obligation there, risk transfer, in the captive, it's a little bit different where the business owner, they have some skin in the game.
Of course.
We call it, it's kind of like self-insurance, but with airbags. There's protection there in place. If you did have a catastrophic claim, right? Yeah.
I like the airbags.
The airbags.
Stop loss, right?
Stop loss.
Exactly.
Yeah. So it's a really good model to where, if you're a safe, well-run company, you do a good job managing your risk. It provides a financial vehicle, but also another peer group of owners to kind of work on continuing to get safer and become a better company. Because at the end of the day, that's really what insurance is, right? Lowering losses, that'll in turn lower your premium, or it should anyways.
Should, yeah, most of the time it does, unless the market goes crazy.
Yeah.
But yeah, from a agent perspective, right? Us and everybody else, they go sell, hey, I'll get you the best coverage, best price, and that's it, right? It's pretty basic. Then you go, okay, next step up is what services can I provide you for safety, for training? And even still, great, if you do well, you just lower your premiums, which again is a good thing.
Right.
But then in your model, if you're clean, describe what happens where like a standard program doesn't give you the benefits back. Because that's the I think the meat and potatoes of the whole deal.
Yeah. A lot of people, and it's funny too, a lot of the customers that we work with, they like the appeal to the captive for the financial perspective for on the front end, but most of the time at the end, they really appreciate the control that they get with it and the services that you mentioned.
Of course.
But for the companies that are very well performing and clean, as we like to call it. Really, what we look at is kind of what's that delta between how much they paid in premiums over those years compared to how much they paid out in claims, right? And your average insurance company, they'll probably have operating costs of 30 to 40% each year to pay for their keep the lights on, employees, all that good stuff, and reinsurance. But the remaining, call it 60 to 70% of their premium, is there to pay for your claims. And so a lot of companies that do a good job managing risk, avoiding accidents, they pay that rate that most other folks in the industry do, but they don't have the same claims to back it up.
Right.
And so the bigger that difference is, the more that we say, hey, you could be a very good candidate for a captive program, taking on some of that risk and hopefully benefiting you in the long term financially.
And then we have averages. It's always at least an average to say people are getting dividends and returns. What is an average return if you have a great year, have some claims? Like, what does that look like for the client that you're presenting this to?
We did a study, and you could probably find it on our website, Captive Resources. But a lot of times we see on average somewhere around 20 to 25% dividend or savings on their policy, over a year-to-year basis. And so it might not seem like a lot, but we do talk with companies that are paying a lot in premiums. It could be $250,000, $1 million or more a year in premium, and that's when you could say, okay, well, 25%. That's one in every $4. That's essentially
huge,
going
though.
to
That's huge.
That's a lot of money that could be going to your bottom line versus someone else's.
Let's talk about risk improvement. Like, okay, so you're doing risk improvement, but then you can also do your company improvement. Like, hey, you can take those dollars away from just doing risk improvement. If you're doing that well, then go whether hire more people to be revenue generating or go do the, patch the next thing that has an issue. Like, you can use your dollars for somewhere else.
Exactly.
What I thought was appealing too is that from a perspective of like insurance, you're grouped together with everybody in the standard world. That's the worst of the best. You're grouped into the same pool.
Right.
Whereas in the captive model, this is really best of the best. So you're not playing the same game at all.
Exactly, and that's really an appealing piece to it. The way that I like to explain it to companies, and again, education is a really important thing for this. It doesn't fit everyone, and it really depends on kind of where you're at in your business life cycle. But just having that ability there, to kind of to manage that, have that peer network that you're saying is really advantageous for those best in class companies, and really looking to kind of take their business to the next level. Right,
of course.
Providing with them with those safety resources, and then on the broker side, it creates a little bit of a better relationship there, because now that I like to say they stop asking you, hey, get me the lowest rate, to hey, help me with some safety stuff. Right, help me get more guys back in the field.
It's more creative that way too, from a broker standpoint, right? It's like that's more fun to be in the business than just like worrying about the pennies, so to speak. So it's like, yeah, I can provide you all these loss services. Hey, we're going to do this claim service. Those are fun. Like you can provide real value that way.
Exactly. And what I like the most about it too is that, everybody, they talk about rate and getting a good deal and everything, but what's really fascinating about the captive is that, you take a different approach to safety and risk management. And what we like the most about it is that, we could look back at a company that joined 5 years ago and be like, you reduced your claim count 40% year over year. Less people getting hurt, right? Going home at night, and that's really the fascinating piece to it for us, watching these companies get safer.
You have skin in the game, right? So that's the positive, is that the skin in the game can create a lot of incentive. On the negative end, if you're not doing so hot on claims, right, there's some consequences.
Yeah,
to
you're
it.
going to pay
you play
for
the game, right?
Of course,
insurance companies lose money every once in a while.
Yeah,
you could if you're not doing well.
Right. And again, it's just an option, and that's why as a broker, you would work with me, and we kind of sit down and say, what's the risk reward here? Does it make sense for them? Or we have conversations all the time. Let's get them captive ready, right?
Captive ready is a good one.
If you like the concept and the model of it, and having some more control, skin in the game, if you will, and a seat at the table in the insurance market. Yeah, let's get you to that point, right? What can we do over the next 12 to 24 months to work on improving, the safety program?
This is another good topic. So what do you tell those people normally? Is it, hey, you need to get a safety director, HR person? Like, what are those things to get you captive ready? Because this is a fascinating concept as well.
Yeah. Well, safety is always probably at the forefront.
The biggest one, yeah.
And having that management team kind of committed to that, mindset, rather than just, hey, we buy insurance to, check the box, if you will.
Yeah.
That's really critical, is having the management team that believes in it, sees the value in it, and the long-term approach there. And so making sure that you got the adequate resources, people in the field on the job sites that are working on a daily basis to manage that safety, but as well as HR, right? And as well, your C-suite kind of setting that culture for the company, right? An employee-focused approach to that, really providing all the resources and training services that they need, in that open and friendly environment where they feel comfortable going to work and
of course,
working with their team there. So
I know on our end, when we have that conversation, we have a company we work with called ESM. They do all claims follow up, and they are like white on rice on those. And it's awesome because they're outside of the insurance company, they're outside of the agency,
right?
So that's all they do, and that seems to help as well. When you put all of those factors together, you can really get someone captive ready, and then when they're in it, they're already doing the right things,
right?
Which is important,
right,
obviously.
Right. Yeah.
So explain, what lines of coverage can you put in a captive? Obviously, I know the answer to this, but just give the people like what goes in there, because we're talking about self-insurance. Some people are like, is this everything? Is this part of it?
Yeah.
What does it entail?
Yeah. So that's a great question, Charlie. And I think it depends a little bit too. There's first off, there's a few different types of captives that are out there.
Right.
We'll clarify that a little bit. Single parent captives, that's something that just about almost every Fortune 500 type company, big, large company, public corporation, they'll use a captive and fund all sorts of different risks in that vehicle.
And single parent, again, just for like lay people, that means just you're big enough to have your own captive. You don't need other people funding it, so to speak.
You're Verizon, you're Caterpillar.
S&P 500, basically anyone on that's going to have that.
Yeah, they're going to have some type of program like that. But captive resources started in the early to mid 80s with the concept of, hey, well, if we had maybe call it 8 companies in the area that combined they kind of look like a larger company, why couldn't we be able to do that? And so that's really where the group captive model started to come into play, and allowing these companies to band together like-minded professionals, and kind of sharing that experience together. So the member-owned group captive is really what we focus on,
right?
And we've got several programs that we consult to in the industry there.
40-something captives.
Yeah, it's grown a lot. Most of them are casualty driven, so it'll be workers' compensation, auto liability, physical damage on the vehicles, and your general liability.
Right.
And we've also looked at and are really making a push into the medical stop loss and employee benefit side,
which made a huge push in recently.
Yeah.
And actually, after this, my podcast is going to be touching on that.
Yeah,
since
that's
we're
right.
really pushing on that. So that's a fascinating concept as well.
Yeah.
The health insurance space, I mean, come on.
Yeah.
It's cool.
And those are, more so than sometimes than what I work on, is that's where the pressure really is for employers, is seeing rising healthcare costs. So those
are big checks to cut, and they're staring at you. Right? Sometimes the property casualty ones don't stare at you as often. You stare at that one every time you pay somebody. It's like, here's health insurance money going out the door.
Exactly.
So it's fascinating.
Yeah.
So anyway, you have the group captives. You have these terms, and I always forget. It's homogeneous.
Yeah, homogeneous and heterogeneous groups.
Right. And so those are like and different.
Right.
So explain that.
Yeah, so the heterogeneous groups, they're going to be a blend of all kind of best-in-class companies from a variety of different industries. You could think we'll combine, hospitality with some manufacturing, some distribution, maybe light construction. Basically, any company that's out there that has a pretty sizable insurance exposure, premium exposure, without it being too risky, right? Nothing that's real catastrophic where you're going to turn on the 5 o'clock news and see,
there's my client,
and all the other members, right? But no, so the heterogeneous captive works really well, bringing all those different industries together. And then, if you did have somebody that was specific to maybe a higher hazard group, we do have consultative programs that are going to be specific to just that industry.
Right. And I've seen those, like the construction ones, are definitely really prevalent. Trucking ones.
Right.
I've seen some other ones for manufacturing that are just for those kind of people.
Yeah.
So those are more the same to same,
right,
more or less.
Right. Like if you had a retail storefront, you wouldn't want to have somebody else in the captive that's putting your roof on top of and falling off or anything like that.
Sure.
So there's that nice advantage there where you're kind of focused. But then on the flip side, for construction or trucking or something, we'll do safety workshops and host that for safety managers, HR directors. They get together, brainstorm, bring in a speaker.
Of course.
But it's really nice because we could tailor the risk profile, the risk strategies that we're looking to do for those different industries, those particular industries together, and really make it much more effective for them in terms of planning out risk management strategies.
That makes complete sense. And I think I ask this question almost every time, but like, what's the number to be paying in the standard market to where you go, hey, this is the number of dollars I'm spending towards these 3 lines of business, or is there a revenue size? What does that end up looking like for someone that goes, yeah, I'd like to consider this?
Yeah, that's a great question. I would say it depends on every business and their risk appetite, of course. But typically, we'll see companies in the general range of around 200,000 up to a couple million or more. And that goes, there's a couple that, we'll still accommodate below that threshold. And certainly we have solutions for folks that are above that threshold as well. But I would say for the most part, that sweet spot is in the, 300,000, 500,000, up to $1 million or so. And then the 1 to 2 million range. And then under 100,000, it gets to be a little bit tricky, because then the risk reward doesn't always line up in the client's favor.
Right. And you have to buy stock, and there's a lot of upfront expense, letters of credit, right? There is work that goes to the front end of it. So if you're too small, like those benefits really start deteriorating up front.
Right. And that's where, a lot of times it's like, hey, you've got a great program right now. This is, unless you did really plan to grow significantly into that threshold.
That's a good point.
We do think that, and I have that conversation a lot with companies that are interested. And I tell them, hey, your broker has a great solution here. The cost won't match up with what you have here. But if this is something like you're interested in, we could work on putting that together for you in the future. So it really just depends on kind of everybody's perspective there. But there is additional costs, like you said, financials that we have to look at and consider because it takes a little bit to capitalize into a program like this, taking on that risk, if you will.
Of course. Now, some of the other things that I always think are fascinating, you kind of hinted on it, but I'm in masterminds where like I get to be around other business owners, pick their brains. You are basically forced to a certain degree to be with those people once a year, twice a year.
Yeah, depending on the group. Some groups will do one.
So you have to go on basically a little vacation. You have to have your board meeting, all that stuff. I think being able to pick people's brains and going, you're doing this, tell me what I'm doing wrong, or tell me how to get on the right path right away, has to be invaluable to these people.
Oh, it's fascinating, to see to watch them kind of come in and not really have any idea what to expect, and then just to go to their first couple meetings, interact with the different individuals, beyond just the captive members that they sit down with. They also have the insurance company there, the TPA,
of course,
that are handling the claims and other key components to an insurance company and reinsurance company. So it allows them to interact with them, but on the other side, like you mentioned, with the other member owners of the captive itself. And so it's really neat to watch them kind of go through different strategies, right? And I've been at meetings in the past where they say, hey, we've ran out of topics for safety, but I'm having a really hard time hiring people in New York City right now. Has anybody had any ideas or, thoughts in terms of finding better people, just with this labor market, things like that. So, it's just an invaluable opportunity for them to really kind of see that come full circle, and then they become family. It's fascinating.
And talking about family, right? You don't leave family. Retention rate, which obviously staying in those captives, once you're in them, it is kind of a long-term picture, which we tell people, like, you want to be in this 4, 5, 6, 10 years down the line. This isn't like hey, I'm going to shop it this year and shop it next year.
Yeah.
Like, you're committing to this long-term. What's retention like once you're in a captive?
Yeah, great question. For the most part, they could get in and out anytime. But to your point, it is really designed more for somebody that's looking at for a long-term insurance solution. And so we typically see companies stay in there, 5, 10 years or more, or until they get sold.
That's where we see a lot of the exits. Is typically from a merger or from being sold. Yeah,
right. And the same thing in like I said here in the captive space too. But on average, somewhere in like the 97-98% retention rate year over year.
Which is awesome. Which is insane.
Yeah.
In our world, right, if you're losing 8% of your business year over year, you're still doing pretty well. So to up it to 2.5-3%.
Right.
It's unbelievable, the delta between those two.
Yeah. And it comes down to, these are business owners that have understood the product, been educated on it, sometimes take more than a year to consider it and talk with other people, which is totally fine. I recommend.
Which is probably, if I was in their shoes, I'd be asking a ton of questions.
Yeah.
And then, because it's like, this is a big jump into the deep end. You want to make sure that you know how to swim out and make sure you're going to be okay. So that makes sense.
Certainly. And so getting that comfort level there. And then once they get in and they, do well, they perform well, maybe take on some additional safety measures and ideas. It just seems to work really well for them. They're betting kind of on themselves and their company and their people, and they work hand in hand with their broker to kind of achieve that level of success that they're looking for from an insurance program. And again, it's a lot of times with family-run companies that join these programs, and the second generation's on, the next thing you know, the third generation's taking over the business, and it just it could work out really well for them for a
really
long time.
Cool. Yeah, and I think that's where we've seen even the stuff that we've sent y'all. It's like, it's the family businesses who are doing well. They want to keep passing it down, and it's like, hey, you might as well bet on yourself, so to speak. To me, it makes every sense in the world to do it.
Yeah.
I don't know how else to sell. I would go every time I could. As soon as I could, I would jump in. But that's just my risk to profile is super high.
But then again, too, to your point, I mean, those types of companies that have been doing the same type of work for a while, a lot of times the kids have grown up in the business and they've seen just about everything and they take it over from mom and dad when they get to that certain point. So I like to say they know what their risks are, they know what their exposures are. It's not a startup by any means. They're not just
they're not learning on the fly,
throwing stuff at the wall, seeing what sticks. Like they know their business inside and out, and they've also built up some revenues, some retained earnings over that timeline to be able to afford that,
of course,
while also still placing working capital and other projects and things like that. So that's why we find that they really do well in these captive programs.
And then some other questions, right? If you were to take like a 5-year window, you talk about like the minimum, like most of the time, I know there's like you're going to win most years. Do you see people winning 3 out of 5 years, 4 out of 5? Like what's the win rate? You're like, I got money back every year except what's a typical?
I would say 4 out of 5 years. Yeah,
incredible.
And look, you buy insurance because you're going to need it at some point.
You will need it.
Regardless of how good of a company you run, there's always going to be those freak accidents.
Of course,
and that's something that we say that's okay. Those things happen, right?
And you have reinsurance for all of it,
right? Yeah. Right. And so one year out of 5, you might not see any financial incentive come back to you. But that's okay because the other 4 out of 5 years, you're going to learn from that mistake. You're going to do everything you can to make sure it doesn't happen again, and buckle down. And you'll be profitable in those other 4 out of 5 years. And so it's just a matter of looking, taking a step back and looking at it in that light,
of course,
rather than like we say, hey, get me the cheapest quote tomorrow for this next year type of thing.
Yeah, which again, like we tend to focus on clients who are wanting to see it as like not just a bottom line number. On their P&Ls, but like, how do I use this properly? And this really takes it to the next level, which is what we really love too. We're targeting the heck out of these markets for it because it makes so much sense from a client perspective and from a broker perspective.
Right. Yeah.
It's really fascinating concept. Now, and then from a claims perspective, obviously you guys are paying claims. You have a TPA, you have a third party administrator that does all of that. And are the incentives any different, right, between an insurance company in the standard market versus like what a TPA is doing in the captive?
Yeah, and that's a great question, Charlie. What I think that might be one of the most important pieces of it. In the captive space, the TPA knows and are trained that these aren't necessarily dollars that we're handling for a big insurance company, but rather for ABC Manufacturing,
right?
And this company put up these dollars. They have some control over that, so you really get to work with the TPA, develop a relationship with them, and have a deeper understanding of what happens when these claims come in, rather than just the insurance company kind of deciding, does this financially make sense to fight, or are we better off settling?
I can't tell you how many of my clients, we all see it too. We know it. It's like, yeah, we're just going to pay it, make it go away. And
right.
Like, nobody has any say.
It's
just what it is.
And then the owner, next year renewal, you got to have that conversation.
And their insurance is going to go up. And we paid out this many dollars. Well, you didn't really try and fight it.
Right.
Right. It seems like a bad double-edged sword in that regard.
Right. Yeah. So having just that extra layer of control, and of course, there's going to be situations where it's like, hey, this is
best to settle this. But
yeah, right. You get that professional advice there from the third-party adjuster. But again, a lot of times, especially in if we are talking California in particular, where the litigation environment's a little bit more employee friendly.
Of course,
I'll say, right. Having just that little extra control there really goes a long way. And even on not just workers' compensation too, but auto liability.
Auto's been big.
That's really where we're seeing some of those big verdicts come out that are driving up car insurance. And it's crazy. I mean, it's both private auto and commercial auto both.
This is a good segue because the market in California, with so many lines of business, is out of control. The property market here is terrible. Everybody knows it, right? We have carriers backing out of California. The auto market, there's very few commercial auto markets writing business in California, which then creates there's not as many competitive options, which is more expensive.
Right.
Workers' comp is still somehow okay, but that's going to change at some point. I always then think back to, I'm telling these clients, I'm like, hey, consider captive because you control more of what happens. Right now, stuff is happening to you, right? The market's happening. Here's your rate increase. Stuff is just happening to you.
Right.
You can hedge that severely right now in your kind of programs, and describe why.
Yeah. Well, the big thing for us is, in the group captives that we work with, they're going to price out their premiums based on their own individual loss history over the last 5 years. And so that, again, if you're a good operator, you're running a good company, and you have all those, controls in place, you're likely going to be beating the national average of, how many other contractors or trucking companies are having accidents.
Of course.
And so just by having that data there, we have an independent actuary develop a loss cost and a premium for them. And so just using that model, I've talked to some folks here in the LA area, companies that have 50 vehicles, and they're getting charged $1,500, $2,000 a vehicle, and then we do the actuarial study, and just because they're so safe, that rate could go down to $500 a vehicle.
Yeah, we've seen $500 to $800. And you're like, wow, this is amazing.
Right. And it's not something that we're doing. This is a testament to you and the company that you're running, right? And so it's really, it's funny because I'll tell them, I'm like, you're getting a better rate than I get on my one Toyota at home, right?
Exactly. It is crazy. I mean, some of these contractors we see with these huge fleets, and you're like, there's no way you're paying $800 a unit.
Right.
But they're in the captive, and it makes a ton of sense. They do a great job with safety. They have dash cams on all of them.
That was my next thing.
They're doing all the right things to make sure that their people are being safe, that if someone's doing a squat and swoop on them, so they rear end them, that they can see it. Like, there's so many good things about what they're doing.
Yeah,
they deserve that rate. Otherwise, they're just hedging the people who do get in accidents.
And that's what we say. When we're talking to these companies, it's like, hey, you're in the top 10 or 20% of the industry pool for the insurance company, but you're subsidizing all the people at the bottom end, right? So you can't get the best deal you deserve because if they didn't get their deal, they would be out of business paying that much.
It's such a great concept for business owners, because what's the first thing they complain about? I had no claims, and yet my premium it's
going up.
Well, that's because the guy down the street doesn't do what you do and likes to run into people.
And he's like, well, how's that my problem?
That's not my problem.
Right?
But this solves that, and you have more control over your own program, which I love. Now, you are with a group, you're with a bunch of different business owners. They are going to have their claims. You're going to have your claims. If you have a bad year as a group, there are some assessments. Like, what does that look like? This is semi the con. Again, there's a lot more pros than there are cons, but there's definitely cons. Got to talk about them. Like, what does a bad year look like? What does an assessment look like?
Yeah. Yeah, so it depends a little bit on the industry and the particular program that they're in, but for the most part, one of the drawbacks is pay to play type of thing.
Yeah.
You could certainly do well and earn some of those dollars back. But on the flip end, you could have years where you have too many frequency claims, too many accidents in one policy year.
Sure.
That could cause you to pay more, right? And I always like to use the example. It's like, if you and I own businesses next door to each other and, we're not in California, we're back in the Midwest in a winter storm or something.
Oh, yeah.
And I'm shoveling my sidewalk and you don't, and you're getting a bunch of claims, people falling on ice. I'm going to look over and say, I'm not paying for those. That's what you got to pay for on your own by being a smart business owner. And so in those situations, when you do have too many of those small losses, you can be up, have to pay more. And it's somewhere, maybe around 40% addition max of your premium.
Right.
And those are things that we lay out clearly up front.
That is the nice part. Your proposals really give you what's my maximum probable expense here on a bad year, right? So this is where I'm going to be at, worst case scenario.
Yeah, yeah. And then on the flip end too, if you're somebody else in the group that didn't have a bad year, you wouldn't have to feel as much pain from those other folks in the group causing that. So it's a really good model where everybody kind of pays for how they did that year, and then there's a little bit there that is risk shared and shifted, making it true insurance, and it works out really well at the end of the day there.
For the policies themselves, I actually don't know why I haven't, but deductibles, are they normal deductibles? They typically higher? Are you guys trying to incentivize keeping small stuff away? What is the thought there?
Yeah, I mean, for the most part, the deductible isn't necessarily as big of an issue in the captive because you're essentially almost like pre-funding a deductible, right?
Absolutely.
Or you're already putting those dollars up, and so we always say report those things, make it known, and then at the end of the day, it's just it comes out of that, with the funds that you put up there. A couple of them will have physical damage deductibles, but for the most part, you kind of just use the loss funding that you have available that you paid in with your initial premium to cover that piece there.
Sure, that's cool. And then the policies, you're kind of built as agents, we're kind of building them, right? So there's some unique things with construction where you need to make sure that there's, your product's completed is right, and you have all those different things going on. Are there anything that you guys won't do from hey, we need to have this coverage on the GL or auto? Is there some limitations, or will you do anything a standard insurance carrier will do?
Yeah. For the most part, it will have a lot of those ISO forms and some of those endorsements. Most of your normal bread and butter ones that everybody
all gonna be there.
Yeah. If there is some unusual stuff, we will dig into it. But all of the captives we consult to, they're with A+15 rated U.S. admitted carriers, and so they've got the ability to do a lot of that stuff there within their respective insurance companies. And so for the most part, that's not too big of an issue. More or less, we see some issues around because the captive won't include your property coverage, and then if you purchase excess or umbrella insurance, those two pieces also sit outside of the program, just because there's. From a property side, there's not much risk control you could do, whether or not you're going to have an earthquake, a hurricane, or any of those tomorrow. And so, as you know, not everybody does, but the package program, that's a big thing, right? Having all of those under one carrier, and then if you tried to, what we say, pull it apart, move a little bit to a captive, and then keep the rest there, well, then you kind of shake the tree a little bit too much, and you can't always get the right prices out of that whole thing. Comes back to the Geico bundle and save,
Sure, yeah.
Right. So, it just depends. And that all comes with, educating the business owner, working with their broker, learning more about the company, and seeing if there's a good solution there at that time, given, market conditions. Of course.
Yeah, market conditions. So we keep coming back to that. That's where I just see so much value right now. How long does it take? If someone says, hey, I'm interested, right? What do I do? What's next? I already have my standard renewals going. Yep. What does that look like for a business owner?
Yeah. Well, first thing is, call your broker, ask them if they got any solutions like that. If they don't, maybe call Charlie.
There you go. That's right.
But, having that discussion and, getting their thoughts on it. But really the big thing, in my opinion, is having a good lead time to sit on it and contemplate it, think about it, talk to some people that maybe are in one. Talk to your attorney or
and you will give.
CPA.
I know you've given other people to hey, here's someone who's in the captive similar to you. Call them, right?
Yeah.
So you've played matchmaker for those people.
Yeah, and we'll do that from time to time. Mostly towards the end of the process when they're really getting serious about it, and are kind of just looking to hear a little bit more. Because the way we look at it, it's like we both work in insurance. This guy grew up doing this type of work. He'll listen to somebody that does that a lot more than he'll listen to us, which I certainly understand and I appreciate. And so having connecting them there is a pretty critical thing. But generally speaking, I say starting with about 3 to 6 month lead time. To do an education, sit down and explain, hey, this is an option. We think it might be good for your company, or you might have heard that it could be good for your company. Let's walk through it, see what it means. And you will fly
out to people, whether it's here in California or Nevada. You go out, people, you meet with them. You want to make sure that they can be comfortable with you, ask questions. What are some common, especially when you're down to proposal time and it's like, all right, what are the common questions that you're getting from these people to go, yeah, this makes sense for me. No, tax advantage, whatever they're going to ask you. What's a common one you're going to see?
A lot of times I would say is, what's my umbrella for you going to be? That's at least in this market, that's something that always seems to be coming up, which is certainly, important.
Well, the market's tough in general for that.
Right. So they'll want to know, how does it compare to my current program? What are the savings? Does it cost more on the front end? And then, some other stuff, how's the property go into it? So a lot of times it's coverage stuff. But then, sometimes we'll have people say, well, can I speak to somebody, right?
Sure.
How's the group doing? And things like that. And again, that's what we do is the consultant to the captive, kind of piece those folks together, and just make sure all those parties are working appropriately. So that way, when they do get together, they're everything's running on one page. In a sense. Yeah.
I love that. Okay. So you get through 3 to 6 months, you get a quote, everything seems good. You finally bind it. You're like, cool, I'm in the captive now. I have a couple really good years. When am I seeing that money back?
Yeah.
Right, that's the big rubber meets the road, right? There's money back, dividends. Explain what that final piece of the pie looks like and what you're putting all that work in for.
Sure. Yeah. So again, if you pay your premium, you have money set aside to pay for any claims or losses that you have. When there's still money left over, it takes some time to come back because, again, you got to remember the lines of coverage that we're looking at: workers' compensation, liability. These things that they take some time, right? If you've got an employee that has knee surgery, that could be 12-month rehab, maybe longer.
Could be longer.
And so a lot of times we hold off, but the board will get together and review data together. Typically, we see it 3 years after that policy year expires, that they'll start to get some form of distribution back. And then typically about 5 years after that policy period expires is when they'll have all premium or full dividend back from that particular underwriting year. But it's neat because a lot of times it does happen at that board level, right? The discussion between the owners in terms of, is this the right time for us? Because, not everybody, especially our customers, they don't work in insurance, so they don't know IBNR as much, is a big thing, right? It looks like the claims are all done. There's nothing there, but you and I both know in this business that claims could pop up from 2 years ago that we never heard about until today.
Well, I was going to ask the construction question. I mean, that's a 10-year window, right? So what happens if you build something, you were on a project, year 9 comes in, boom, the water pipe breaks, it was your fault. Like that, it's still on you 9 years later.
Yeah.
Right. So there's a huge lag on that kind of stuff. Yeah. Workers' comp, all of a sudden, someone has a shoulder problem from 4 years ago they didn't tell you about. All those issues come up.
Right. And I will, not to get too deep into an insurance conversation, I'll save this for, off the line. But, there are, exit strategies for those old liability years that we work with in the groups to get that liability off of the individual company's books. And it actually came up, just in conversation last month with, a contractor that said, hey, what happens if something like that occurs, 9 years down the road?
Exactly.
And there's, the structures in place to avoid that falling on you as a business owner and, sell that liability off to a third party. So it's really fascinating, once you get to that
we've
size.
Talked about it, and I was like floored when you told me this years ago. I was like, you can do what? Yeah. It's just such a cool concept.
Yeah,
but you're playing a different game at that level,
right?
Honestly,
right.
So there's part of it.
Yeah, I mean, you really got to think when you do get together with 100, 200 other companies, and you guys are all of decent size and very,
all have nice attorneys.
Yeah, but you have leverage in the marketplace and buying power. So whether it's a TPA or an insurance company, they care a lot more about you.
Oh yeah,
as a whole group than they do one individual policyholder on the side. And so it really goes a long way for the clients, and that's why it comes back to when they see us 10 years down the road, they're like, yeah, we love the concept of saving money. But now it's like we have so much more control, stability, predictability. You know, if we're looking to grow, we have a really good idea where our costs are going to be. Whereas in the standard market, we just don't always know how much it could fluctuate up or down in the next 3 to 5 years. You really just are much more insulated from those market conditions in a group captive program.
So cool. Yeah. Okay. So then there's the last part where it's like, all right, you know, we're getting paid money. There's a difference between a distribution and dividend. Like you guys you do put the money into the market that is set aside for different claims costs and all that. They are getting that money at the same time, the 3 to 5 year window. How are those dividends paid? Or is that different?
What's that now? Just the...
Because you're setting aside money that goes into the market, right? Because you guys are helping them. It's mutual, correct? Yeah. So when are they getting those dividends just on investment dollars?
Oh, so those will typically come in tangent with
okay, cool.
With the loss funding dollars as well. Yeah. The mutual fund concept to it. That's a feature that we started in the 90s for the customers, and it's really neat because it's actually ran by the individuals that are across our portfolio of groups we consult to. But it goes back to the core concept of insurance, right? You pay your insurance company X amount of dollars, and they say thank you, and they take that money on day one, and they've got their own investment team. They distribute it in the market, and so that's what we want to do and allow middle market business owners to do for their own insurance.
The reason I always bring that up is because I've heard so many of my clients go, "Well, I should just start my own insurance company." They're being coy about it, but then I'm like, "Well, you can act just like one and do the same things they do. You just have to fit into this model, right, and understand it." And then the eyes go up and they go, "Oh, no way." Right. So I always think that's a fascinating one to go, "Oh, I can actually play insurance company, be a real insurance company." Yeah. Yes. Which is cool. Any tax advantage? I know they're not huge, but again, as a business owner, it's one of the questions I asked. Is there any tax advantage to this for me as the business owner?
Yeah, I mean, it's not so much a tax play, and I obviously certainly do your research because there's different captive programs out there, and certainly some might say that it could be or couldn't be. All of the programs that we work with, they pay taxes to the IRS, of course, at ordinary income, and so. But the big thing comes back to having those dollars that you could actually receive back and be taxed, and so it works out really well. Obviously there's some differences between domiciles and where they're working out of things like that. But yeah, as long as you have a good tax consultant, I'll say I'm not a CPA now or anything.
I just know from a base level, there's a difference between capital gains and dividend income. All of that comes back as dividend income, correct? Yes. For the most part. Yeah. So you pay it's a different rate, which is helpful. Right. So that money back isn't getting hit as hard, which is awesome. Yeah. Again, just small tax feature, which I think is cool. That helps. In a real way to kind of wrap it up, I think this is one of the best concepts out there to really play the game at a level that just other companies can't, right? Once you start getting big enough, you should be taking advantage of the scale you have. Yeah. There's a right fit for you. As far as going about it, it's not a difficult process, really. There's a little bit more work up front to get into it, but once you're in it, it's just smooth. So as long as you're doing the right things, I don't see why you wouldn't do it.
Yeah, no, I agree with you. Like I said, I came across this when I was studying insurance, and I was like, this seems like the best thing since sliced bread. It makes so much more sense to me than a lot of the other products out there at the time, and I still believe it. But like you said, there are certain constraints, and the cost to get in, and depending on do you want to spend extra money to capitalize into that, of course. But for those companies that it fits the model, and they really are at that time in their business life cycle that they feel this is a good solution. Very high success rate, and a lot of them just really appreciate what they get out of it. Because and we like to say you never know what you're going to learn at the next meeting. It's true. Whether it's a safety meeting or a board level meeting with the other owners, there's always something. It could be a presenter that's giving a speech, or just a side conversation you have with another business on the other side of the country, and you just start talking with each other. And you really learn a lot, and for us, that's what's really rewarding is that we get to see that firsthand. Just so many positive experiences come out of this for the companies that we work with.
Of course, I love it, Ian. Thanks for coming on, man. This was such good information.
Yeah, thanks for having me.
And for y'all that watch, if you want to take control of your insurance program, contact me. Me and Ian will be working together on your program for your property and casualty, and we know we'll be at least good to go through the exercise of seeing if it's right for you, having an honest conversation. We've done this before. You're very honest. You'll tell people if it doesn't make sense.
All the time.
We'll get you captive ready. You know, we'll work through all those steps of what that looks like. So if you're interested, reach out over us at Greyhawk, and we'd love to have a discussion with you. Ian, thanks again, buddy, and appreciate you being here.
Thank you for having me, Charlie.
See y'all.
Appreciate it.
Take care.
Thank you.
Bye.